Let's play it. I'll pull apart every claim once it's over.
That somebody who makes 75 grand a year, goes to work every day, is raising a family, is struggling, hasn't built a net worth up like that. That doesn't sound like a pejorative that say that the U.S. government doesn't think they're sophisticated?
It sounds like a system we left to create one of aptitude. So it seems like we ought to create a way to allow anybody who's willing to put in the work to learn the risks they're taking on.
So they're not smart? So you make 75 grand a year as a police officer, nurse, EMT, auto mechanic, sales consultant, you're not smart or sophisticated? Is that what, Mr. Dumas, would you agree with that?
So I think we should take a step back. So according to the current definition, if you have a household who has over 200,000, 250,000, whatever the case may be, right, the loss is not the same. So if you're a police officer and you were to invest in these assets that are probably more risky than a typical asset you have an ordinary investor, losing $50,000 to a sophisticated investor may be a cost of doing business.
No, that wasn't the question. I'm saying, is that definitionally make you not very smart or not very sophisticated?
I don't think so. I don't think any type of.
So then, why would we define it that way? And what's the point of the definition? Is it mean that some bureaucrat is smarter than you are?
It doesn't mean that, sir. But I think also you should think into the fact that there's definitely risk aspect to it.
But they're not able to understand the risk because of their level of income.
I don't know. Well, I can't speak on whether they understand the level of risk.
But that's the rule. That's the law today, correct?
According to Mr. Bly's law today, but
I just think that's an extraordinarily paternalistic view of the American people, and I think the American people need to know that they have a government that doesn't think that they're very smart or very sophisticated based on how much money or net worth they have, and I think that's actually decently grotesque, from my perspective. I think that's we talk a lot about wanting to advocate for working Americans. I think we should start by not demeaning them. Mr. Dumas, you talked about digital assets. You call it crypto. I mean, I'm going to assume you know the difference between all these digital assets. What percentage of Black Americans hold digital assets?
According to, I think, a recent study, is a low percentage. I think overall, not just Black people. I think according.
No, I'm just talking about Black Americans. What would you guess?
I'd probably say 2%.
2%. And how about Hispanic Americans?
Sir, I don't know the statistics.
Guess. No. White Americans?
Well, overall, according to Federal Reserve study, 9% of Americans, all Americans, own.
All right. Would you be completely and utterly flummoxed to know that Black Americans hold more digital assets than any other ethnic group? And it's 20%, 19% for Hispanics, 18% for whites. And would you be equally flummoxed to know that 66% of whites hold stocks, 39% of blacks hold stocks, and 28% of Hispanics hold stocks? Meaning that you think it's riskier for the 6.6 million Black Americans that hold crypto assets, that you don't think they should. And who are you to decide whether they should or should not?
First, I would say I would question the actual study.
It's from Pew. You can look it up.
Well, I'm sure, but I would question whether or not the 20%. I would obviously see how they make the determination. My whole point is that it's the idea of crypto providing this access to all, right? In a sense where you produce this type of predatory inclusion to where some people are thinking that they can hit it big, right?
Well, but so 6.6 million Black Americans are not sophisticated or intelligent enough to know that they should or should not have bought digital assets?
I'm not saying that, sir. I'm just saying that I first have to question that number you're using. And second, I would say that, I think people need to appreciate the risk, right? I don't know there's enough disclosure, enough information for people to understand, appreciate the risk, because crypto is a very volatile asset.
Well, on the behalf of the 6.6 million Black Americans who do, I disagree with you.
Mr. Bentsen, you would agree that in general, businesses that do the same kind of activities in the market should be subject to the same kind of regulations, right?
Yeah, at first I should say we support your legislation, but yes, sir.
Thank you. I mean, we want to have an even playing field. Would anybody disagree with that?
All right, we have a rule book. The rule book should apply. It may be, regulations often written based upon size and stuff like that, but there should be a baseline rule book, yes.
Exactly, and that's how you prevent loopholes. That's how you create an even playing field. As I'm sure you're aware, SEC Chair Atkins has said that he'd like to put out what he calls an innovation exemption from the security laws. We don't know all the details yet because the SEC hasn't released them, but it does seem that this exemption would carve out certain crypto businesses, like DeFi platforms, from the rules that apply to everybody else. Mr. Bentsen, in a comment about this innovation exemption to the SEC, you wrote that many crypto firms, including DeFi platforms, perform the same functions as traditional brokers and exchanges. That means, and I'm quoting, the crypto intermediaries should be subject to identical or at least substantially similar rules and oversight, end quote. In other words, if the FCC exempts crypto and DeFi platforms from security laws, we'd get an uneven playing field that undermines the markets, right?
Yes, that was in one of the dozen letters we've written on the issue. If we believe you can, if you're engaged in the securities business, you're being compensated to engage in similar securities activities, whether it's order routing, custody, whatever it may be, then the same rules should apply.
That seems like common sense to make sure we protect a level playing field. The challenge we have right here is the Clarity Act, which is proposed legislation before the Senate, has the same problem. And here's how a Wall Street Journal editorial board put it on Tuesday, and no left-wing outlet, the Wall Street Journal, and I'm just putting up the headline, "Clarity for Crypto, sort of." And then they say the Senate bill to regulate the digital currency needs changes to reduce risks to the financial system. And I think this is a warning for all of us that that bill is not ready for prime time. They say right now that if you read it, you'll find that the argument is that it will migrate to shadow markets. More investments will migrate to shadow markets with few or no investor protections. You would agree that that would be a concern, would you not?
Yes, Senator. So if I could say two things. One is I've long said, Congress should act in this space. So good for Congress to be acting. We think the bill that came out of the Senate Banking Committee had a number of good things in it, where there were clarifications that needed to be made, things like bank permissibility, portfolio hedge netting, and trying to address some of the concerns around what rules apply to DeFi when you determine between a programmer, a computer programmer, versus somebody who's actually in the business. So that's good. When the bill got to the Ag Committee, some of those things didn't carry over. And so we do have concerns with the bill as we understand it today, but we haven't quite seen it, so we don't really know. But we do think that it is important for Congress to set the rules, but I agree with the Wall Street Journal editorial from yesterday. I think it's very well written, that you can apply the existing rule book for the securities and commodities markets for activities that are being done in that space, however they're being done, whether they're being done digitally, on paper, whatever it should be.
I agree. It should be technology neutral.
Right.
And that was the point you were making with respect to the, quote, innovation exception. And I think that same principle applies. And that's before even getting to the conflict of interest and ethics issues, which is another huge loophole. So even if we were able to fix that,
Or in the overtime.
we still have.
There is no question but that as times change, as different technologies come forward, and as we learn about what regulations work correctly and which ones need to be tweaked, there's no question but that there has to be a review of regulations on a regular basis. I believe in your opening statements you've indicated that the Jobs Act is probably one of the last times that we've actually looked at this with regard to capital formation. That was in 2012. So here we are 16 years or 14 years later, we're now looking at it again and on a bipartisan basis. Can you talk a little bit about the reason why those regulations that were there at that time versus what they are now, why there would be a reason why we should take a look at maybe updating those regulations?
Thank you, Senator, and that's a great question. The securities industry is one of the most regulated industries in the American economy, and we operate under a rule book that was really set in place 80 years ago, right, coming out of the Great Depression. And over the years, Congress has made changes to that through multiple statutes, appropriately so. But I do think that it's important for Congress to go back on a periodic basis, not just to look at the rule book that the regulators put in place, but to look at their own laws that they put in place, because markets change, products change, technology comes into place. Some of the things we're dealing with today in terms of the capital formation, Edgar filings at the SEC, those were originally done with paper. Now they're done electronically. And how we deliver confirms and proxies to clients has changed, and where we're going more and more to e-delivery, and many on this committee are proposing going to e-delivery, the SEC, et cetera. So I do think it's appropriate for Congress to go back and look. They do the best job they can at the time, but they have to go back and see, did it work? And what's changed in the market since
And the
then.
vast majority of that could be done on a bipartisan basis, I suspect.
Absolutely.
Mr. Flood, I appreciated your comments. I think it's important that we talk about both the individuals who are trying to invest, that want to find something other than simply investing in a savings account. And they look at where real wealth is developed. And part of it is you start out with savings. And once you have some savings where you're, because of the work you're doing as a family, as an individual, at the end of the month, you've got more in your account than what you had to begin with, and you've paid your bills. And at some point, you want to take that as wealth, as an opportunity to grow your own wealth, and you want to put it someplace where it could perhaps gain interest, or in some cases, equity. The markets today allow for two different types. One is for individuals to invest in privately owned businesses. It might be their own business, or it might be with a small group, and those seem to have a real opportunity for development. The other is in the markets themselves, the public markets. But there's a big cost involved in that, because we're trying to make them as safe as possible for average investors. Can you talk a little bit about what the real opportunities are for someone to invest perhaps a little bit easier in some of those IPO or pre-IPO programs versus in the markets that we supposedly put out for the general public, but that are regulated to the point where there's added costs and perhaps a little bit lower rate of return on investments in them? And the reason why we want to perhaps provide more opportunity for small investors to look at both, those that are private type companies and those that are publicly traded. No, it's not working. Slide it up
over.
to you, yeah.
I promise you,
There we go.
I can string a sentence together. But when I think about that, I think there are a few opportunities. One is on the investment side, but you talked about two technical fixes that I think bring things into today's world. One is when you think...
Then I'm going to run out of time, so you might
Okay.
want to make it quick.
Closed-end funds allowing access by changing the exemption. And then two, making sure that when we talk about some call it double counting fees, but with AFFE, making sure that we rationalize the disclosure. Because right now the disclosure is wrong.
Thank you.
So those would be my...
Mr. Bentsen, as it relates to the definition of an accredited investor. Well, I look at it. I grew up in poverty in a single-parent household. I will say that without any question, creating wealth seems to be something that is consistent but not necessary. There are a lot of bright folks with great ideas who need early access. And when you look at the accredited investor definition, I think it actually should be updated. I think this is a bipartisan conversation that we are now having. Both Republicans and Democrats seem to understand and appreciate the importance of not just having a wealth definition for whether or not you have the aptitude to be an accredited investor. Love to get your thoughts on that topic, and Mr. Flood, I may come to you next.
Thank you, Mr. Chairman. Congress over the years has gone back and forth and looked at how they should define accredited investor, and they've looked at it in terms of a quantitative test, but also now there's efforts and there's legislation, as you referenced, to look at it in a qualitative. And there are, and I think it is appropriate, we think it's appropriate to look at it in terms of other types of sophistication and accreditation that an investor may have. For instance, when I was an investment banker, I was a Series 7, Series 63 registrant that requires you to go through multiple financial testing and the like. You can have CFAs, so one of the most intense financial testings that go on. You may not necessarily have millions of dollars, but you are a sophisticated party at that point in time. So we do think it's appropriate for Congress to take a look at that and make adjustments based upon the individual investors' other accreditations.
Yeah, Mr. Flood, any thoughts on that?
Yeah, actually, when I looked at the proposals that the dais has put together, it attempts to allow retail investors to access the private markets in 3 responsible ways. 1, show your aptitude by passing a test. Clearly, someone who's going to take the time to do that is interested in the market, is going to understand the risks. 2, if you allow 403B access like we allow in 401k, let's not forget that there will be a plan administrator. They will look at the investments, they will look at the risks, and they will curate them and display those to the retail investor. And then 3, if you can use an advisor, you can go that route too. So if you have all 3 routes, and all 3 come with the exact same protections that you would have if you invested in the stock market. And if you think about it, we will allow an individual to invest in penny stocks, OTC, and equities. And we're actually enhancing the controls to allow people to invest in the private markets. So I think people understand the risk.
Nebraska businesses are the economic center of communities across my state. Excessive federal red tape forces many Main Street businesses to compete on an unlevel playing field. That's why I introduced the Elevate Act with Senator Cortez Masto and partnered with Senator Gallego to introduce the HALOS Act. Both bills will make it easier for small enterprises to unlock available capital and drive our local economies forward. And as has been mentioned here today, the United States has the strongest, most trusted capital markets in the world, and it's because of the regulatory structure that we have in place. Our system relies on clear rules, reliable disclosures, and enforcement that is predictable and grounded in law. Fair and transparent regulations allow our country to have the most liquid, transparent markets in the world. And those standards matter even more in a time of strategic competition against Communist China. Communist China is not just another foreign market participant. Communist China is our greatest existential external threat. They are a strategic competitor with a state-directed economy. According to the U.S.-China Economic and Security Review Commission, roughly 286 China-based companies were listed on U.S. exchanges as of March 2025. Combined together, that represents about $1.1 trillion in market capitalization. That means that a meaningful share of American retirement accounts, mutual funds, and index funds routinely have exposure and hold these securities in their portfolios. American retirement savings are flowing into China-backed companies operating outside the reach of U.S. regulatory oversight and protections. It means Americans' retirement dollars and our markets are used to promote Communist China's businesses. That's why I introduced the No China Index Funds Act last June, because the retirement savings of everyday Americans should never be funneled into companies controlled by Communist China by default, without those Americans ever having made that choice. 151 of those 286 China-based issuers represent about 90% of the total market cap, and they use variable interest entity, right? They're a variable interest entity, VIE arrangements. They use these structures because China law restricts foreign ownership in key sectors, so they can't sell equity in the operating company directly to U.S. investors. Instead, investors buy shares in an offshore holding company that relies on contracts, not ownership. Mr. Bentsen, Mr. Flood, Mr. Dumas, yes or no, do you believe that the average American retail investor understands that difference today? Mr. Bentsen, we'll start with you.
First of all, we don't represent the index providers, but I think probably a lot of investors don't understand how the index models work and what's included in that.
Mr. Flood?
In disclosure, so we got to make sure that the appropriate disclosures are there for people to
Do you
understand.
think the average investor knows that when they're investing in these index funds that it's going off to Communist China because that's part of the index? And it's not even directly invested in a company, it's just in one of these VIEs?
Not without reading disclosures.
All right. Mr. Dumas?
A great question. So I actually have, I'm an investor, and if my fund's going to China without proper disclosure or information, I wouldn't have any idea.
Yeah, thank you. Ms. Blass and Mr. Bentsen, in your view, are existing disclosure requirements adequate to clearly explain those ownership differences to investors?
So the disclosures themselves, yes, but they are dense, and are investors going to actually look for them? The answer is no. when you look at indexers and the rules of the road there and how they include these companies and whether these companies have the same obligations like U.S. companies in terms of disclosures, that is something actually that was looked at and has been continued to look at, and definitely the policymakers and regulators need to continue looking at that to safeguard American investments and retirement savings.
You agree with her? Okay, great. I have concerns about how these VIE structures allow Chinese companies to raise capital in U.S. markets without being subject to the same ongoing disclosure, governance, and oversight standards that American companies face. Under the current rules, Chinese companies using VIE structures can still qualify as foreign private issuers. Mr. Bentsen, among all foreign private issuers, is it fair to say VIE issuers based in Communist China are the ones raising the most serious oversight and enforcement concerns for American investors?
I don't know that I can answer that, but what I can say is where we do have concerns, and I know you brought this up, is on low price, the low price securities and the impact that's had on investors and issues, and where the listing standards have not been, and the pump and dump schemes, exactly. And we thank you for bringing that up. We have raised that with the exchanges and the SEC repeatedly. To be fair, NASDAQ recently came out with revisions to, and we don't represent them. They're, but they came out with revised listing standards, which we think is a step in the right direction to address the low price issue.
Well, this is an issue that's important to me, and I've raised it with Chairman Atkins. It's crucial that we get this right because we are putting, I think, investors' dollars at risk without their understanding what that risk is, and we're also helping to fund companies in our chief adversary in the world, and they are not playing by the same rules.
What I've been trying to work on, and actually working with the Chamber on in New Jersey, for instance, is about really trying to create this new innovation hub, really trying to bolster the type of technology development and innovation we're trying to do in our state. I've called it, creating this Einstein corridor between Philadelphia and New York. And, as we've been going through this process, I've been, trying to think through things. And, the chairman raised this earlier about, how we see so much of the venture capital funds, for instance, concentrated in Silicon Valley, New York, and Boston. And I guess I just wanted to pull on this a little bit further. From the chamber's perspective, what policies do you think would be most helpful in directing more private capital towards emerging innovation hubs rather than the places where it's already been established?
Senator Kim, thank you for your question. I want to start by backing up a little bit and saying, I think when it comes to innovation, we all have to realize that you need a network in almost every area. You need a place where you can pitch deals. You need a place where you have others who have like minds, like a healthcare hub, and you need funders to be there to talk about it. So when I look at the proposals that have been put forth by this committee, as well as in the INVEST Act, I see a few that can be very helpful. And a lot of them are very technical, just common sense fixes. Again, I'll go back to the AFFE. If we can solve that, I would honestly, some people say we're double counting. I actually say because we are double counting, that is a misrepresented disclosure. So if we technically fix that, it'll allow these funds to make it into indices and make more liquid investors, not only for retail investors, but for those funds themselves. Two, we should look at some of the definitions, and you all have talked about it here, making sure that the rules for emerging growth funds, the rules for venture capital funds have met inflation. Let's raise some of the thresholds so that the businesses that were at $125 million can still invest as they were 10 years ago. Their assets have gone past that value. So we've lost the ability for people to invest simply because inflation has taken their asset values higher. And then three, there's some really common sense things. If someone wants to go public as we develop these innovation hubs and create a deeper market for smaller venture capital funds who want to go to the local areas, as we bring companies to come public, there are simple things we can do too. Like making sure that there's an alignment between the financial statements they need to release as they go public. Making sure that we ask ourselves the appropriate question, do we need an audited financial statement? They're exceptionally important, but if we're trying to deepen the amount of companies we have, where should we draw that line on an audited financial statement pre-IPO? If there's an IPO, of course there should be one. but where do we draw that line on cost benefit?
Yeah, no,
There are a lot of common sense approaches that get us home.
Well, I'd love to be able to continue talking with you
Yes.
and others about that as we try to build on. I want to kind of scope out a little bit even further. I mean, we're talking about how do we try to get that investment, that wealth, develop more across this country, but also just trying to think about it in terms of American families. So, we see great strength when it comes to our markets, yet we're seeing still too many Americans, particularly those in rural and underserved communities, disconnected from some of those opportunities. And so, Mr. Flood, I guess when I'm thinking through roughly half of Americans still not participating in the stock market, from the Chamber's perspective, what are the biggest barriers keeping families, particularly in rural and underserved communities, from becoming long-term investors, and what policies could safely expand that participation?
That's a very fair question. I think we should all remember that access to 401k plans is almost at an all-time high. So the ability to access savings plans is relatively high. The ability to know that you can is not that high, or how to do it. And of course, making sure we have the money to invest is problem number one, but what we can talk about is creating that access. So I think there's three aspects. One, financial literacy is exceptionally important. Two, I think it's really important to see what the SEC Small Business Advisory Council is doing. It is putting out a lot of information about not only how can we help small businesses in state and local areas, but how can we help investors get involved. Three, I think you have a bill on crowdfunding. It's a small way to increase the pool to allow people to participate in investments. And four, as we've all talked about today, making sure that no matter what American you are, you have the ability to invest in the private markets. That money then gets recycled back out.
Formation. Capital formation may sound like a Wall Street term, but at its core, this is about Main Street in America. It gives local businesses and everyday investors the tools to turn good ideas into jobs, growth, and a stronger future for their own communities. The best ideas in America do not come just from New York or San Francisco or a handful of other communities. They come from places in South Carolina like Latson, Irmo, and Simpsonville, and communities all across America. But too often, access to capital is concentrated in too few places and in too few hands. That means an entrepreneur in South Carolina may have a harder time accessing capital than someone with the same idea in Silicon Valley. That should not be the case. Opportunity should not be dictated by your zip code, and it should not take wealth to create wealth. My priorities are simple: to expand investment opportunities for everyday Americans and increase wealth outside of the hands of a concentrated few. To do this, we need help to help companies go public and stay public. And we need to help small and medium-sized businesses access the capital they need to grow, hire, and compete. That's good news in so many ways, and it is not starting from scratch. Last Congress, I introduced the Empowering Main Street in America Act because too many Americans lack access to our capital markets. IMSA would have expanded the ways everyday Americans can invest in growing businesses, and it would have tailored regulations for companies at every stage of growth, from a startup and beyond. Since then, members on both sides of the aisle have also put forward common sense proposals that can help move us in the right direction. I've teamed up with Senator Warner on legislation to help emerging companies, growth companies, scale and ultimately access the public market. Senator Britt has introduced legislation co-sponsored by Senator Warnock to level the playing field between 403Bs and 401k plans, giving 15 million nonprofit employees, from hospital workers to teachers, access to the same lower cost investment options as everyday 401k savers. Already, 13 members of this committee have signed on as co-sponsors. Senator McCormick and Senator Alsobrooks have introduced legislation to eliminate red tape that inflates the reported cost of business development companies, making it more attractive for investors to put capital into the small and middle market businesses that BDCs are built to serve. And there are more ideas we can build on. That is why this committee is working to update the capital formation package that I put together. Our capital markets should help a company grow from an idea to a small business, from a small business to a larger employer, and maybe one day to the next great public company. That is the point of today's hearing. We want to hear from our witnesses about what is working, what is not working, and where Congress should focus our attention to make capital formation even easier. This committee has shown time and time again that we can work together on serious issues that matter to the American people. Helping a small business grow is not about politics. Giving families a chance to invest is not.
SIFMA has long supported legislative and regulatory efforts to encourage companies to go public by ensuring the costs and requirements associated are appropriately tailored, allowing issuance to flourish without introducing unnecessary risk to investors or the broader market. The Jobs Act, passed by the Congress in 2012 with our support, is a prime example of how legislation can help companies access public markets and secure funding for growth. We believe this benefits not only issuers, but also investors by providing greater opportunities to participate in long-term wealth creation. Supporting stronger public markets does not mean diminishing the role of private markets. Both play important and complementary roles in capital formation. While private markets provide valuable financing options, policymakers should seek to reverse the long decline in public company listings like IPOs. By conducting an initial public offering, a company gains access to a broader pool of capital that can be used to fund growth initiatives, invest in innovation, pursue acquisitions, and strengthen its overall financial position. Liquidity and public price formation further distinguish public markets. Shares can generally be bought and sold with relative ease in secondary markets at transparent prices, giving investors the flexibility to reallocate capital as their financial needs or market conditions change. In addition, public companies enjoy broader access to capital markets for follow-on equity offerings and debt issuance. While the market value of U.S.-listed equities has increased more than fivefold over the past quarter century, the number of publicly listed companies has moved in the opposite direction. The U.S. public company universe has contracted from approximately 7,200 firms to 5,500 firms over the same period, a decline of nearly 25%. Whereas U.S. averaged 459 IPOs annually during the 1990s, the average since 2020 has fallen to just 196. Even so, there is ample evidence that the Jobs Act has expanded access to public capital markets for smaller companies, facilitating capital formation through a more efficient and less burdensome IPO process. The Jobs Act has expanded access to public markets since its enactment. Emerging growth companies have raised nearly $440 billion across 2,100 offerings. Notwithstanding the success of the Jobs Act, we believe policymakers should continue to evaluate whether existing regulations appropriately balance investor protection with the costs and complexities associated with becoming and remaining a public company. SIFMA supports the recent legislative and regulatory steps, including the House's passage of the INVEST Act and several measures introduced by members of this committee. We also support the SEC's proposed reforms to expand shelf registration eligibility and emerging growth company status, as well as SEC and FINRA efforts to expand research coverage. Congress should also consider policies that broaden investment opportunities for retail investors. Targeted reforms in these areas can strengthen the competitiveness of U.S. capital markets while preserving robust investor protections.
Chamber of Commerce, the world's largest business organization, represents businesses of all sizes, the substantial majority of which are small businesses. We thank Chair Scott for leading the charge on capital formation with the Empowering Main Street in America Act and the broad bipartisan effort by senators of this committee on capital formation legislation. Main Street America depends upon vibrant and accessible capital markets for economic growth, innovation, job creation, retirement security, and America's ability to lead in the global economy. When businesses can access capital efficiently, they hire more workers, invest in new technologies, and build the products and services that drive the American economy. When investors, including everyday Americans, can participate in that growth, wealth is built broadly, not just at the top. The wealth changes lives. It enables parents to send their kids to college, families to buy homes, and entrepreneurs to start new businesses. Chamber is here today because we believe Congress has a critical and time-sensitive opportunity to enact meaningful capital formation policy that reflects the needs of today's small businesses, investors, and the overall economy. Strong capital markets are essential to American leadership. The United States has the deepest, most liquid, and most innovative capital markets in the world, representing approximately 45% of global public equity and fixed income capitalization. And nearly 75% of all U.S. corporate finance comes from U.S. capital markets. However, the capital markets must be enhanced in order to compete. The number of U.S. public companies has fallen by nearly 40% since the 1990s, from over 7,800 companies in 1997 to 4,700 today. Let's put that in perspective. There aren't enough public companies to fully comprise the Wilshire 5,000. The decline is not a market anomaly. It is evidence that the current framework is not working, that the cost and complexity of accessing public markets has outpaced the benefits for far too many companies. And just as importantly, foreign capital markets are offering effective solutions. If the trend continues, your constituents will lose out on access to potential jobs through public companies and also options to save for their futures. Another answer is expanding small business access to capital. As I like to say, the Chamber represents nearly 3 million businesses. While many are recognized in the Fortune 500, the other 2,999,500 are small and medium-sized enterprises. Small businesses comprise 99.9% of all companies in the United States, 47% of the workforce, and have comprised 62% of net job creation since 1995. From startup to IPO and every step in between, the regulatory framework should facilitate, not obstruct, access to capital. Smart reforms like HALOs and raising the investment advisor threshold, for example, for inflation, can expand the networks that are crucial to entrepreneurship. And finally, another solution is to strengthen and create more public companies. Investor protection and capital formation are complementary goals. The reforms proposed by this committee, such as Elevate and allowing companies to submit draft IPO documents to the SEC, achieve both. And finally, we should expand investment opportunities for American investors, workers, and retirees. Capital formation is more than just helping companies raise money. It is about providing every American the opportunity to invest in the growth of both U.S. public and private markets. For too long, the most dynamic investment opportunities have been available only to those who already have wealth. Smart legislation can target this fundamental societal inequality while maintaining strong investor protections. So, Senator Warren, we agree that money and power should not equate to special treatment, and that's why we want to provide responsible access to retail investors to the private market. We therefore ask the committee to continue its bipartisan momentum. You passed legislation that will help millions find an affordable home. It was not easy, but you prevailed, as you always do. Bipartisan support for capital formation legislation is just as overwhelming, including with the administration. The Senate work product has much in common with the House-passed INVEST Act, which passed with a whopping 302 votes. There's absolutely no reason why Congress can't come together again to pass bipartisan legislation this year to provide Main Street businesses better opportunities to grow and thrive, increase public company jobs in America, and allow every U.S. investor, not because of their income or wealth, but precisely because of their aptitude, a better opportunity to save for their futures. If we accomplish this together, your constituents will be much closer to living the American dream. Thank you.
This was a Senate Banking Committee hearing with a dry name and a big stakes question. How hard should it be to raise money in America? And who gets to invest in the fastest growing companies? It sounds technical. It's actually about your retirement account. So let's step back from the sparring and lay out both sides fairly. On one ground rule, this isn't about whether you like the senators or the witnesses. It's about a real trade-off. Making it easier to raise capital can fuel growth and open opportunities, but looser rules can also expose ordinary savers to risks they can't easily see. Both of those things are true at once, and that tension is the whole debate. Start with the problem everyone actually agrees on. Here's the documented backdrop. The number of publicly listed U.S. companies has fallen sharply from its peak in the late 1990s, by roughly a quarter to a third, depending on who's counting. Public stock offerings are far rarer than they were a generation ago. Meanwhile, more and more companies stay private, where the biggest gains often happen. Both parties agree this shift is real. They disagree on what to do about it. And that's the core divide. Republicans, who chair the committee, argue the fix is to cut red tape, make it cheaper to go public, and let more people invest in private deals. Democrats argue that loosening the rules invites fraud and pushes everyday savers into opaque, risky assets. Same shrinking market fact, opposite prescriptions, and which risk worries you more is the real question. Take the Republican case at its strongest. Here's the deregulation case at full strength. Going public has become expensive and legally risky, so fewer companies do it, which means ordinary investors are locked out of early growth while the wealthy and big funds get in through private deals. Supporters, including the industry witnesses, say easing disclosure burdens and modernizing the rules would revive public offerings and let Main Street share in the gains. It's a genuine fairness argument. A big piece of this is the accredited investor rule. Right now, to buy into most private deals, you generally need to earn over $200,000 a year or have $1 million in net worth. Critics of the rule, on both sides actually, call it arbitrary. It gates the best returns purely by wealth. Bipartisan bills would let people qualify by knowledge or a licensing test, not just their bank balance. Now the Democratic case, just as fairly. And here's the investor protection case at full strength. Private markets are opaque, less disclosure, hard to sell, and harder to value, which makes fraud easier and losses harder to see coming. Democrats and the consumer protection witness warn against measuring success only by how much money gets raised. Their sharpest worry is pushing risky assets, including crypto, into everyday retirement accounts, where regular savers can least afford a surprise. There's also a real bill moving through Congress. This hearing wasn't abstract. The House already passed a capital formation package called the INVEST Act, and notably, it passed with real bipartisan support, 302 to 123. It bundles more than 20 smaller bills, easing the path to going public and broadening who counts as an investor. It's now in the Senate, which is exactly why these witnesses were there. The crypto question was the flashpoint. Chris Van Hollen held up a sign borrowing a newspaper headline. Clarity for crypto, sort of. To argue a separate digital asset bill only looks clear. Be fair to the other side of that, too. The industry witness, the head of the main Wall Street trade group, argued the crypto bill has, in his words, a number of good things in it, and that clear rules of the road are better than the current uncertainty. So even on crypto, this wasn't simply for or against, it was a real argument about whether the specific rules are written well enough. So strip away the jargon, and here's what this hearing really was. Not a fight over whether the stock market is shrinking, both sides agree it is, but a fight over the trade-off between access and protection. Open the doors wider, and more people can build wealth, but more people can also get hurt. Where you draw that line is a real choice, and it hasn't been made yet. Watch 3 things from here. Whether the Senate passes the capital formation package and in what form, whether the accredited investor rules actually get modernized, and whether any move to put private or crypto assets into retirement accounts comes with real guardrails. Those answers, not the hearing room sound bites, will tell you who was right. That's our breakdown. Stay with us.